Here's why the housing market is likely to experience a lot more pain in the near future and what that means for you as a potential home buyer in 2023. Home sales have declined for 9 straight months, driven by surging mortgage rates, and now investors are starting to pull back more than traditional home buyers, with investor purchases dropping 30% as home prices slow down. At the same time, we're seeing the probability that the Fed is going to hike the Fed funds rate at least 50 basis points, sitting at 100%, with 71% of interest rate traders sitting at 50 basis points, along with the other 29% sitting at 75 basis points, with the likelihood that you're going to see short-term interest rates rise sitting at a very high probability. And these short-term interest rates affect things like student loans as well as credit cards. This is coming at a time when we're seeing household debt soar at the fastest pace in 15 years, as more and more people are starting to use credit cards. As you can see here, the biggest contributors to that debt load is actually coming from mortgage balances, which rose $1 trillion from a year ago to $11.7 trillion, and credit card debt climbed to $930 billion. Also, credit card balances collectively rose 15% from the same period in 2021. This is the largest annual jump in nearly 20 years. And a lot of this has to do with inflation and the cost of goods rising. As you can see here, inflation has boosted U.S. household spending by nearly $433 a month. Even at a time when many Americans out there aren't having to even pay on their student loans, as the Biden administration once again extended the payment pause on student loan debt. So while many Americans out there are struggling to make it work on a monthly basis because the cost of goods rising, they're not even having to take into account that student loan debt. So once that student loan debt comes into play, consumer spending is going to continue to get worse at a time when Bezos is urging consumers and business owners to reduce risk in the face of a likely recession. Jeff Bezos once again warned of the challenges of an economic recession, telling consumers and small business owners they should reduce their risk by hanging on to cash and delaying big purchases. In addition to Elon Musk saying a global recession could last until the spring of 2024. So the likelihood of us seeing a slowing economy is real talk, and that's going to continue to affect home buyers' pockets unless interest rates come down significantly, which we're not likely expecting. I'd like to take a minute and ask for your help. My goal with this channel is to educate as many home buyers and sellers as possible, and one way you can help me do that is by hitting that thumbs up. It helps the YouTube algorithm, helps more people see the video, and in turn helps me accomplish my goal of helping educate more home buyers. So at the moment, we saw interest rates about 2 weeks ago drop from just over 7% down into the mid 6% range. And with that, we actually saw mortgage demand increase by 2.2%. So with interest rates coming down, we saw some people that were on the fence jump back into the market and try to take advantage of these lower interest rates. But what you're likely to see over the next couple of months is a slowing housing market. As of right now, we just passed the Thanksgiving holiday and we're moving into the slowest time of the year. This is a time of year when more and more inventory is going to come off the market, as sellers are less likely to want to sell their homes, have people walking through their homes during the holiday season. So we're likely to end the year at the lowest levels of inventory that we've seen in the last 6 to 8 months. And this is normally a time where I would say that you're going to see the lowest levels of inventory that we're going to see all year. But what we saw at the beginning of this year was the lowest level we've ever started a year with. So I don't think we're going to get back to those levels, but inventory is going to continue to decline. And with less homes on the market and interest rates really not moving big in either direction, you're likely to see less home buyers out there looking for homes, which means there's less people actually putting in offers, and in turn, less people going into escrow, and ultimately less people closing on these properties. And I honestly think you're likely to see that at least for the next 3 to 5 months, unless you see a big change with regards to interest rates. And if interest rates continue to move in the range that we've seen, not really going higher than the peak that we saw a couple weeks ago at just over 7%, I think you're likely to see home prices continue to move sideways, down in many markets. Now, I'm not expecting home prices to crash, but at the same time, if a seller is in the market and needs to sell a property, they might need to discount it heavily in order to unload that property. But I don't believe that's going to be the norm for many markets out there because a lot of sellers have locked in super low interest rates. And so they're somewhat locked into these properties because even if they were to sell that home, they have to go out and either rent something, and they would likely have to pay a higher rent fee to get a comparable property as to what they're paying on their mortgage, and or buy a higher priced home with a higher interest rate where it doesn't make sense to sell that property. But at the same time, you are going to have people that need to sell properties for one of the 3Ds: death, dying, divorce. Something happens in one of those scenarios and a property's on the market. Well, if you're a buyer out there, these are the opportunities along with new construction. As I've mentioned in other videos, builders aren't in the business of holding on to property. They want to sell these homes, and a lot of them have a fiscal year end ending at the end of December. So many builders out there are going to discount their prices. They're going to offer incentives to try to unload these homes. And that's where the real opportunity is in this market. As you can see here, mortgage delinquencies decreased to a new low in Q3 of 2022, which likely means you're not going to see any foreclosures come to the market anytime soon. So as I've mentioned before, buying a home isn't about timing the market. It's about time in the market. If you're trying to pick a top or a bottom in the market, it's a fool's game and you're likely to lose. But if you're buying a home for the right reasons, because you have a growing family or because whatever the reasons in your life make it make sense, and you have that longer term time horizon, then you're likely to be fine. But if you're someone looking for the short term, you're looking to buy a home right now, and you think in 2 or 3 years you're going to be able to sell it and make a profit and buy another home, I would be a little bit weary of that. I expect that housing prices are likely to move sideways for the next couple of years. We're coming off 2 years of nearly 40% appreciation. And with interest rates sitting above 6.5% at the moment, that's putting a huge strain on affordability, and also it's putting a strain on home price growth. With that said, if you're somebody that is a home buyer, but now is not the right time for you, use this as a time to work on things so that when the housing market does present an opportunity to you, you're in the best position to take advantage of it.